Assalamu alaikum. Welcome to the class of Finance and Banking, Chapter 5. This is the last class of Chapter 5. Today we are going to discuss about creative questions and its solution. Let's start. Mr. Jahid is thinking of investing in a project. According to the income expenditure estimate, the initial investment of the company is 25 lakh taka. The duration of the project is 4 years. 4 years ago, pre-tax income was 10 lakh, 15 lakh, 10 lakh and 18 lakh respectively. Depreciation is 1 lakh 25,000 taka per annum. Tax rate 40%. Company's benchmark payback period is 2 years. Question number A. What is the discount rate? We know that discount rate is the interest rate used to determine the present value of future cash flows. Number B. Why is capital budgeting expectation based? Explain. Capital budgeting is mainly expectation based because most of the factors used in the evaluation process of capital budgeting decision are based on future, which is always uncertain. Calculation of future cash inflows and outflows is based on assumptions. That's why capital budgeting is based on expectation. Number C. Determine the average rate of return of the project proposed by Mr. Jahid. As the profit given in the question or stem is pre-tax profit, so we have to deduct tax amount from this profit and determine after-tax profit. With those after-tax profit, we can get net profit, and which is needed for calculating ARR. At first, we have to draw a table where we need 5 columns. One is for particulars and another 4 is for amounts per year. Particulars and amounts per year, year 1, year 2, year 3 and year 4. We are writing pre-tax profit 10 lakh, 15 lakh, 10 lakh and 18 lakh. Then we have to deduct tax of 40% from this. This 40% is on pre-tax profit. 10 lakh into 40% equal to 4 lakh, 15 lakh into 40% equal to 6 lakh, 10 lakh into 40%, 4 lakh and 18 lakh into 40%, 7 lakh 20,000 taka. Now we are deducting this tax from the pre-tax profit. The results are net profit 6 lakh, 9 lakh, 6 lakh and 10 lakh 80,000 taka. So average net profit is, we know sum of the net profits divided by number of years. Here 6 lakh plus 9 lakh plus 6 lakh plus 10 lakh 80,000 divided by 4. And the result is 7 lakh 95,000 taka. Now, as no salvage value is given here, so the average investment will be initial investment divided by 2. Our initial investment was 25 lakh taka and divided by 2 we get 12 lakh 50,000 taka. So ARR equal to, we know, average net profit divided by average investment into 100. And our average net profit was 7 lakh 95,000 taka divided by average investment 12 lakh 50,000 taka into 100, and the result is 63.6%. So the average rate of return of project proposed by Mr. Jahid is 63.6%. In our question D, it is said that use the payback time method to determine the rationale for investing in the project. So we have to determine the payback period of this project. For determining payback period, we need cash flows, and no cash flows are given here. So we have to calculate it by adding depreciation with the net income per year. Here depreciation is given, and that is depreciation per year 1,25,000 taka. We are writing in our table at first net profit 6 lakh, 9 lakh, 60 lakh, 90 lakh, 60 lakh and 10 lakh 80,000 taka. And we are adding depreciation per year with this 1,25,000 taka. The results are 7,25,000 taka, 10,25,000 taka, 7,25,000 taka and 12,05,000 taka. With these cash inflows, we can determine cumulated cash inflows, and as these cash flows are not same per year, so we have to draw a table for determining payback period. We are drawing a table of 3 columns here: cash inflow and cumulated cash inflow, and we are writing the cash inflows respectively year by year: 7,25,000 taka, 10,25,000, 7,25,000 and 12,05,000 taka. And cumulated cash inflows are 7,25,000, 17,50,000, 24,75,000 and 36,80,000 taka. Here the initial investment of our project is 25 lakh taka, which is denoted by MCO. The fourth year's cumulated cash inflow is 36 lakh 80,000 taka, which is over 25 lakh taka. That means our full year is this year's previous year. That means year 3. Year 3 is A, and full year's cumulated cash flow C, 24,75,000 taka, and the cash flow after this year's is D. So the D is 12,05,000 taka. Now we are putting these values in the formula of payback period: A plus NCO minus C by D. 3 plus 25 lakh minus 24 lakh 75,000 divided by 12 lakh 5,000 taka. And our result is 3.02 year. And in our STEM it is said that company's benchmark PBP is 2 years. And our calculated PBP is 3.02 years, which is above 2 years. So the project is not profitable at all, and it is not logical to invest in the project. We are jumping in the second creative question. Ahmed traders in considering investing taka 4 lakh in a long-term project. During this time, he estimated the income and expenditure of two projects called Rupa and Bithi for 5 years and got the following information. Project Rupa cash flows per year and Project Bithi's cash flow per year. At first, the question number A, what is capital budgeting? Capital budgeting is the evaluation process related with long-term investment decision. Number B, explain the factor that differentiates between cash flow and net profit. The factor that differentiates between cash flow and net profit is depreciation. As depreciation is a non-cash cost, it is reserved in our hand. For this reason, it is added while calculating cash flow. On the other hand, as it is a cost, it is deducting while calculating net profit, and that's why it differentiates between cash flow and net profit. Find out the payback time of Ahmed Traders Rupa project. We are seeing in the STEM the cash flows of Rupa project is not equal year by year. So we have to draw a table. You can see a table here. Year cash flow and cumulated cash flow like previous solution. And here the initial investment NCO is 4 lakh taka. The third year, that means in year 2017, our accumulated cash inflow is 4,25,000 taka, which is above 4 lakh taka. That means our full year is before this year. That means 2016, and this is the year number 2. So A equal to 2 years. full year's cumulative cash flow is equal to C, that is 3,25,000 taka, and D is the cash flow after this year, that is D equal to 1 lakh taka. We are putting this in the formula of payback period. 2 plus 4 lakh minus 3,25,000 taka divided by 1 lakh, and our result is 2.75 years. The payback time of Ahmed Traders Rupa project is 2.75 years. Now the question number D. Which project do you think should be adopted for the long term? Before deciding about which project should be adopted for long term, we have to know about both projects' payback period. From question C, we can easily know that the payback time of Rupa project is 2.75 years. Now we have to calculate the payback time of B3 project. And like before, the cash flows received from B3 project is also not the same amount every year, so we have to draw another table for calculating the payback period of B3 project. And this is the table year cash inflow and cumulative cash inflow you are seeing here. And the initial investment of our project NCO4, the third year cumulative cash inflow, you see 4,65,000 taka, which exceeds 4 lakh taka, and so that our full year is the year before this 2016, that is year 2, and our C equal to 3,35,000 taka, and the cash flow after this year's D 1,30,000 taka. And our payback period is 2 plus 4 lakh minus 3,35,000 taka divided by 1,30,000 taka, and the result is 2.5 years. The payback period of B3 project is 2.5 years. And we know that the payback period is, the lower the payback period, the better the project is, and our payback period of B3 project is less than the payback period of Rupa project. You know, 2.5 is less than the 2.75, so B3 project should be accepted. I hope you will understand the creative solution. So here is a homework for you. Do it and send it in my inbox. Thank you.